So as we come to the week, January the 20th, just watch out for Trump's comments on the inauguration as US president. He could really move the dollar in particular, so keep that in mind. So we'll have to interpret the pairings and the futures contracts that are suitable for this week, depending on what Trump says on Monday. We'll do that live real time, so that's relatively straightforward. But for now, just bear in mind, reason we're looking at calendar events is to find those high probability trading opportunity. Here's one opportunity we had on Friday's non-farm payroll going back to the 10th of January. It was a great event and worth recapping. So enjoy. So why are we looking at these calendar events? To find high probability trading opportunities. Here one on Friday the 10th of Jan that we took. Non-farm payrolls super hot. The prior was revised down, but only fractionally. The unemployment rate below the Fed's projected level and below forecast 4.2%. Average earnings was 3.9%, so slightly deflationary, but nevertheless, taken as a whole, that was a clear opportunity for further dollar strength, further expectations of more aggressive Fed holds. The fact that the market was expecting the Fed to still be cutting interest rates. Some analysts started to say after this strong print, particularly from the Bank of America, said that's it, no more Fed rate cuts, and they see a slight chance of a Fed rate hike. Right, so all of that negative for stocks, positive for the dollar. That's what we're looking for. Covered the event live. If you just take a look here at the last Fed projections from the December print, you can see they were, looking at inflation being stickier, and they were expecting interest rate to be higher for longer. This strong non-farm payroll print was exactly the confidence the Fed need to see that the labour market is robust, strong. They won't need to necessarily cut interest rates in response to a weakening labour market. So we're covering that live, and we were looking at clear opportunities. Sell the S&P 500, sell euro dollar, sell New Zealand US dollar, buy dollar yen, and there were clear opportunities there throughout the day. S&P 500 at the time with the print, we're looking for a move down to that 5840 region. We hit that beautifully. And with the euro dollar, we're also looking for a move down to that 102220 region. Hit that, and we can see we're heading down towards the lows. For now, in the futures market, looking at the E-mini, this was something that I was personally shorting, and you can see here that when I look at the day, if you look at all the little different opportunities that I took, 73% winning trade percentage, total P&L of $2,000, and you can see here that I had, two sort of losing trades. I was managing the position, and all the rest winning trades across the day, just taking advantage of that negative sentiment around the S&P 500 and just taking that lower for the session. So that's why we look at the high probability trading calendar events. We see clear fundamental drivers we want to take advantage of, and that was one for the 10th of January on Friday. As we look ahead to this week, the first thing just to bear in mind is we have President-elect Trump inaugurated on Monday, the 20th of January. So the first thing to look out for is any Trump tariff surprises. So the dollar's recently been pulling back on expectations that maybe Donald Trump is not going to be as aggressive on implementing tariffs as originally thought. But if Trump comes out and sort of says, 30% tariffs on Chinese imports, 30% on Canada, anything like that, then look for immediate dollar strength. Just keep that in mind as we go through the week. That'll be on Monday. It's not a calendar event per se. There isn't a scheduled release for when you might say that, but just keep it in mind. The first opportunity we're going to have will be with the pound. Now, if you look at last week's credit default swaps, what we saw is that even though there was a big surge in yields, it wasn't matched by a significant rise in credit default swaps. In other words, it wasn't a sovereign debt risk that was driving the sell-off in the pound. However, this week, we do see a little move in the credit default swaps. You can see it's definitely spiking higher. So is it massive concern? No, but it's something that could grow. So just keep that in mind. And there could be, further exuberant selling of the pound if that credit default risk really becomes a material risk. At the moment, the move in gilts is in line with other bond markets around the world, and the latest weakest CPI print out of the US has helped bond markets around the world. So for now, that pressure's just been alleviated. However, with that being said, the UK CPI print last week was softer. It wasn't soft enough to give us a clear tradable opportunity, but it was soft enough to change Bank of England pricing for their next interest rate decision. And if you look here, you can see from last week, there was a 63% chance of an interest rate cut from the Bank of England. Now, there is a 79% chance of a Bank of England interest rate cut to 4.5 on the February the 6th meeting. So, and you can see that expectations are in place for lower interest rates. So that has weakened the pound, that CPI miss, makes sense. So with that being said, the first opportunity is this, UK labour data. If UK labour data comes in and surprises markets to the downside, shows a weakening in the labour market, look for sudden selling in the pound. Now the pairing will decide nearer the time, but this is definitely something to look out for. UK labour data is one economic calendar event not to miss next week. Then we have Canadian data on the same day later on in the afternoon. Now, the situation with the Bank of Canada is they're expected to cut interest rates, but if we see CPI data coming in significantly lower than expected, then that will give the Bank of Canada more grace to cut interest rates more aggressively to support sort of a struggling economy. And the CAD has been, suffering recently with the dollar strength and the threat of Trump's tariffs, etc., etc. So if we see a big miss in the CPI data to the downside, only interested in trading a downside miss, then that could give us another leg lower in the Canadian dollar, but it would have to come in below market's minimum expectations across the board. Nevertheless, it's one not to miss on the same day as the UK labour data. Then finally, we've got European PMIs. Now this kicks off with the French data at 8:15, leading into the German data at 8:30. So it's a staggered release, but it is worth checking. All 77 respondents surveyed by Reuters expect the ECB to cut interest rates on their next meeting coming up on January the 30th. So what we want to see here, and if you look short-term interest rate markets, see by June, they see like 3 interest rate cuts coming, and many analysts are seeing 4 interest rate cuts coming in the first half of this year. So struggling growth, pessimism around the Eurozone, ongoing Ukrainian crisis, prospect of Trump's tariffs has all been just weighing on the euro. So what we're looking for here is something that just bucks that trend. Some PMIs that just come in above market's expectations, just see a little bit of profit taking on the euro short positions, a little bit of relief. The sort of euro dollar sell position is quite stretched now, and any kind of potential release could allow that to snap back. So what we're looking for on the Friday is PMI prints coming in above market's maximum expectations. It'll be staggered release, start with the French data, then the German data. By the time we get to Euro data, the move's already taken place. So that's what we'll be looking for on Friday. It could give us an opportunity in the Euro. So they're the top 3 events that are really mattering for this week.